Rates drop, and right now you're wondering if you're about to make a wrong move. You don't want to overpay. You also don't want to miss an opportunity, but you also don't want to look back years from now and realize you made a huge mistake trying to save some money. That tension is real, but before you call your bank, you need to hear this. I've seen someone lose $13,200 trying to get a lower rate. And the thing is, this mistake happened years before they tried to break their mortgage. I worked at one of Canada's largest lenders, taking these calls every day, and I can tell you that it's not a rate that determines whether you're breaking your mortgage or not. Something else does, and most homeowners don't even know it exists. Today, I'm going to show you how to know when you should look for a lower interest rate. I'm also going to tell you the 4 different numbers that you need to know in order to make an important decision. Also, I'll show you the calculation that you make to determine whether you should break your mortgage or not. Because once you understand this, you stop reacting. You start making calculated decisions rather than just following the headlines. Following the headlines is where people make their first mistake. So let's start there. Here's how it usually goes. You hear the news, a friend refinances, or you see a headline, and your payment, it seems high. And you think, are we overpaying? That's a completely normal question. But refinancing doesn't start with a lower rate. It starts with breaking your current mortgage. And your current mortgage has a cost to break it. And most homeowners don't calculate this properly. So if I asked you right now, do you know how your penalty is calculated? Would you know? Would you know what your penalty is? Before we get into the break-even math, let's see how a penalty works, because this is where everything changes. Some mortgage penalties have 3 months of interest. This one's easy to calculate. You take your monthly interest amount, multiply it by 3, that gives you your 3-month interest penalty. The other one sounds a lot more complicated, but we'll break it down so you can understand. It's called an interest rate differential penalty. We like to call it a loss of interest penalty because of how it's calculated. Essentially, all the bank is doing is looking at your rate, comparing it to what rate is available to your closest term. For instance, if you took out a 5-year term and 2 years later you try to break it, they would be comparing your 5-year rate with the 3-year rate available today. The difference in interest rates between those two, that gives you the loss of interest penalty. Now, here's where it gets uncomfortable. Some lenders do not charge you penalties on what actual rates they're charging today. They use what's called a posted rate, a higher inflated rate that they advertise, and it allows for them to charge higher penalties. And so what does this do? Well, that widens the gap in the loss of interest penalty. So it makes penalties higher. And now here's the part that should make you feel really uncomfortable. A lender could change their posted rate tomorrow, your penalty would change, and you wouldn't know it. So although in some instances you may think that you've gotten the best rate, when it's time to leave, you might be super surprised. Let me tell you how some people look at getting the lowest rate and don't realize the implications afterwards. And so let me illustrate to you how penalty math can make a huge difference to your finances down the road. So a client locked in to a rate of 6.29% with TD, 0.1% lower than the rate that I was offered. Over 5 years, that person would have saved $2,300 for that 0.1% over the 5 years. At the time, it looked smart. Now rates dropped, and when we looked at breaking their mortgage, their penalty on that was over $30,000. If they had taken the option that was 0.1% higher, because of the way they calculated the loss of interest penalty, that penalty would have been $16,800, a $13,200 difference. Now, think about this. The 5-year savings was $2,300. The penalty difference was $13,200. And this changed their entire decision. It turned the math from being beneficial for them to break to having to continue on at the higher interest rate until maturity. My 5-year-old played soccer, and most homeowners view mortgages the same way that these soccer players go. So one kid chases the ball, 5 others follow. They don't see the open field. They don't see the goalie. They don't see who's open. All they can focus is on the ball. And homeowners do this with rate. One person gets a rate, 5 others around them want the same rate. They don't see penalty. They don't see structure. That's how some small rate wins can be huge financial losses. And I'm not saying that rate's not important. it is, but it is only one of four factors that you should look at. Look, if I have to, I'll just stay with my mortgage company forever. Yeah, let me tell you a different story to give you some perspective. So I had another client who was looking at selling their home. Okay, they had a house picked out in advance before they put an offer in. I just asked them to call and figure out what their penalty was. The penalty was over $25,000. Now, luckily for my clients, they didn't have to sell. So they decided not to list and to wait until their mortgage term was closer to maturity to lower the penalty. If they would have sold, they would have lost that amount of equity and wouldn't have known it. And in some cases, especially where housing is right now, that $25,000 penalty could be the difference from breaking even, selling a condo, to having to put money into it even after you sell. So these penalty conversations are important, even if your plan is to never negotiate your rate during your term, because there are instances where you don't know if you're going to have to sell or not. And I've been talking a lot about really scary penalty numbers, 25, 30,000. This is not always the case. And let me phrase it this way. If you had to pay $1,000 to get $10,000 back, would you? Most people would. And that's where refinancing is good. So you can't just stop thinking, oh, my penalty is going to be crazy high. The real question you have to ask yourself is, does the lower interest rate outweigh the penalty calculation? The real question is, does the savings outweigh the cost between now and the end of your current term? I call this the break-even trigger. So let's say that your penalty is $18,000 and you save $400 a month in interest. That would mean that it would take 44 months to break even, but you only have 32 months left in your term. So this does not make sense to break. However, in the same scenario, if your penalty was $9,000 and you save that same $400 a month, it would be worth it because you would pay it off long before your 32-month term is up. Now, saying all of this, there is an instance where even if this number doesn't work, there's a scenario where you should break your mortgage. And this is the fourth number that often gets overlooked, and that is your other debt. For instance, let's say that you have $30,000 of credit card debt, and the current rate on those cards are about 20%. If you were to go from a 20% interest rate to a 4% mortgage, that would save you about $4,800 a year in interest. That also has to be factored into your calculation as to whether it makes sense for you to break or not. So we run the same test: the penalty, the savings, and the timeline. And doing half the math leads to full mistakes. So you need to do it all. But there's another factor that you need to be aware of before you make your decision, and that is the direction of rates. Now, I'm not here to tell you that we can predict rates years out. We can't. But we can see 6, maybe 12 months in the future. More likely that 6-month range. And if we're expecting rates to go down between now and 6 months from now, there are benefits to waiting on making changes to your mortgage. Now, why is that? Well, as time passes, your interest rate differential can shrink. You have less time, and in some instances, you're being compared to a rate that has a higher rate normally. These are 1 and 2 year rates. Historically speaking, these rates have been higher than 3, 4, and 5-year rates. Not always, but as a general rule, that's usually the case. Now, something to keep in mind: as rates go down, penalties can also increase because the rate that you're getting compared to also goes down with it. So something to factor in is, don't take a penalty from 6 months ago and think that it applies today. I like to think about this. I love chess, and to think you don't make one move at a time because you're excited or because I can attack the king. It's more important to see, okay, what are they doing? Now, what should my response be? Okay, if I respond like that, what's going to happen in the future? It is important to think more than one step ahead. The deeper that you think about this, the easier and the more likely you're making a right decision. At the start of this video, you were focused on one number. Now you're focused on 4. What's my rate? What's my penalty? How much time do I have left? And what other debts do I have that will change the payment calculator? That shift protects you, but this is what most homeowners miss. They enter the negotiation phase of rates completely unprepared, and that can quietly cost them thousands of dollars more. Look, lenders and brokers don't automatically send out their best rates. You have to know how to position yourself. So if you've already pulled out your mortgage statement, if you already figured out your penalty, don't let that discipline go to waste. Watch this next video before you make a move, because knowing when to refinance protects you from your mistakes, but knowing how to negotiate the best rate protects your upside. And the people who win long term do both.